Hello, promise. Yeah, also, can you hear me? Hey there. Okay, so we're kind of waiting for some people to join us, so let's just wait for some minutes.
I hear you.
Okay, that's fine. So I'm just see if we can wait a little because it's just the two of us. I think somebody is joining. Somebody is joining. So I mean,
I can hear you.
yeah, I know. Yeah, Razak. Okay, so we have Razak joining us as well. Okay, so I think what will just happen is we'll just start. We'll not want to waste too much time. Okay, so last week we started with sensitivity and scenario analysis, and we concluded on scenario analysis by giving an example. So remember I shared my screen with you guys, and we did explain scenario analysis. So we had some issues with the interpretation. So I'm going to share my screen now. So we're just quickly going to briefly look at that again before we now move to the business of the day. So if you observe on the group, I'd already shared today's discussion with you, which is valuation. So we are actually treating valuation modeling today. So I shared that with you already, but for now, we'll just quickly take a look at the interpretation of the last thing we did on the scenario analysis. So if you look at this file again, it's the same file, the same S&B PLC. Well, what we are just doing is we are building on this file to show different situation we can have under financial modeling. All right, so in that class we discussed scenario analysis. All right, now I explained this to you. So what I'm going to do right now is to just quickly do I'm just quickly going to do a recap of this scenario analysis because we had issue with interpretation. All right, it's very important that we do this before we move straight to the next topic. So what I'm going to do right now is, if you look at what we have here, you can see this is already a solved question. All right, so I sent you the unsolved question. Okay, just because we want to do a recap, so I can just briefly reintroduce you to this. So what I'm going to do now is to take out this. So I'll show you how we're able to arrive at this scenario table and the interpretation. Actually, the interpretation makes sense. Okay, so what I'm going to do right now is I'm going to take this out so we can go through this again and see where we had issues the last time. All right. So I explained to you that for you to do scenario analysis, okay, there were some questions that was raised. Can someone hear me, please? Yeah, can someone hear me? Okay, okay. I can see okay. I can see Razak joining us. Can see okay and Razak joining us. Can someone hear me?
Yes, I can hear you.
Okay, okay. All
I'm
right.
hearing you.
So no problem. Thanks for the feedback. Yeah, I just want to make sure that someone can hear me before we proceed. All right. So we last week we were discussing scenario analysis and we had issue with the interpretation. So what I'm just going to do right now is to do a recap of that so we can interpret and see this actually makes sense. So I promise you we're going to look into this again this week. And that's exactly what we want to do. Now, when we talk about scenario analysis, I did made mention of the fact that for scenario analysis, we are looking at uh, whenever you hear the word scenario, okay, three things should come into your mind. Now, what are those three things? Number one is that you have a base case. A base case will tell you as it is, meaning the current situation. That is a base case or current value. After the base case, you will have optimistic case. Optimistic case tells you the best case. That means given that things go well, okay, what what will be the performance of the business. And pessimistic case is also known as the worst case scenario. Given that things go wrong, what will be the performance of the business? Now, the problem we had in that last class was that we actually made the wrong selection in the scenario summary. And that was why the interpretation wasn't making sense. Because if you look at it, I highlighted some parts here in yellow that shows that our interpretation wasn't in sync with what is ought to be based on the analysis of the optimistic and pessimistic case. So what we want to do right now is to go through the whole scenario analysis all over again so you can see how we arrive at the final result. All right. So what we're going to do right now is we're going to start this all over again by saying we are considering the scenario for 2017, right? We are considering the scenario for 2017. So the first thing we're going to do, of course, is to come to our scenario. Once you have this, you have your data, right? Now you can see this is for 2017. So the performance metrics we are looking at is the impact of revenue growth, cost of goods sold. This is cost of goods sold, right? Revenue growth, cost of goods sold, depreciation and amortization and interest. The impact of these are assumptions, right? The impact of these assumptions on these performance metrics, given the condition that we have a base case, optimistic and pessimistic case. So that is what scenario analysis tells us. So what we're going to do right now is we're going to come to from home. All right, from home, I'm going to select data. You can be jotting down these steps because it's important you take them down. Okay, so let me go through that again. I'm going to say we're going to take this class gently. We're not going to rush ourselves. So, and at the end of the class, I'm also going to do a recap of some of the things we have talked about in the past because I understand some persons don't understand what we have done for in some of the topics. Before I introduce you to valuation modeling, we are not going to complete valuation modeling today. We're just going to introduce ourselves to it and see what we need to talk about. All right, so here I'll come to home and I'll come to data, follow the steps, then I'll come to what if analysis. Now from what if analysis, I'll select scenario manager. All right, so what I'm going to do right now is I've already created scenarios here. I've created some scenarios here and that's why you can see all this here. All right, so I'm going to do right now is I'm going to take out these scenarios. I'm going to take out all of them. So you can see I've taken out all of them. All right, so we're not going to waste too much time. All right, so what we're simply going to do now is I'm going to put this side by side so that you can be seeing how the changes will appear. All right, so I'm going to click on Add. All right, so when I click on Add, the first thing I'm going to do is I'm going to say, I'm going to type optimistic here. Okay, so I'm typing optimistic there. Now after typing optimistic, the next thing I'm to do is to go and select my changing cells. Now please note, your changing cells are your assumptions. Your changing cells are your assumptions. And what are these assumptions? Revenue growth as a percentage change, cost of goods sold as a percentage of revenue, depreciation and amortization as a percentage of PPE opening balance, and interest as a percentage of debt opening balance. So what you're going to do is to go up. You're going to go up, and meanwhile, you want to see the impact of these assumptions on these performance metrics for FY 2017. Please, impact of these assumptions on these metrics for 2017. So what you're going to do is to go up. All right. Now, this is where we have 2017. 2017 is one of the focus period, right? So ensure you are selecting the right thing. Okay. Take note of it. We are selecting revenue, COGS, depreciation, and interest. So revenue, okay, I've selected revenue, comma, COGS also for 2017, comma, depreciation also for 2017, comma, right? Then interest also for 2017, all right, also for 2017, comma. I think that's all. No need for comma there, because that's the last thing. All right, so that's all. So we selected the changing cells. First revenue, second COGS, third that we selected is depreciation and amortization as percentage of PPE opening balance, and we selected interest as percentage of debt opening balance. All right, so that's what we'll do for the optimistic. Now that is not all. Now the idea is, immediately I select this, once I select this, Excel is going to recognize this as the base case scenario. Excel is going to recognize this as the base case, meaning the current case. That is, if we are not assuming optimistic, if you are not being optimistic or pessimistic, this is what it is. Okay, in 2017, this is what the assumption is, because we are not optimistic and we are not pessimistic. That's why it's a base case, because we are not optimistic, we are not pessimistic. So if I want to prevent changes, I want to protect this, I want to prevent changes, I check this. If not, I uncheck it. But I actually want to prevent changes, so I can check this. So we can always leave this as a default setting. All right, so what you now do is you click on OK. All right, so you have clicked on OK. Now this is when you will now set your optimistic case. I need to admit someone. Okay. All right, Sheye. So Sheye. All right, so this is when you will now set your optimistic case. Now, if you observe what we have here, in 2017, can someone hear me? So you observe that in 2017, we have 5% here as a base case. So if we are optimistic for revenue growth, if we are optimistic, it means it should increase, right? If you're optimistic, it should increase. So we can say this is 8%. For COGS, cost of goods sold, is 37%. If we are optimistic, then it should be favorable, right? So we can say this to be 20% because we are optimistic. For depreciation and amortization, is currently at 40%. It's going to be lower, so we can say 30% because we are optimistic. Now for interest Interest is at 2%. If you're optimistic, it will be lower. So we can say at 1% because we are optimistic. So now we click on OK. Exactly. So once we have OK, this is what comes. This is what comes in. Now, so successfully, we have been able to define what is optimistic. What this means is that we've been able to tell Excel that Excel, fine, this is the base case. If we are not optimistic, this is what we have. And if we are optimistic, this is what we have. So that is exactly what we have done here. So this is the first stage. All right. So the next stage is now for you to go and define your pessimistic case. So you still go on and click on Add. Now you click on Add, scenario name becomes pessimistic. Scenario name becomes pessimistic. Now, this time around we are pessimistic. We are still pessimistic. Now, because we are not changing our scenario, because we are not changing our assumptions, okay, so we are still applying this pessimism to the assumptions we have selected. The assumptions are not changing, right? So we are going to leave the changing cells the same. We're not going to touch these changing cells because the assumptions are not changing for pessimism or for the worst case scenario. So what we're just going to do is to just click on OK. So it takes us back here to the scenario values. All right. Now you observe that we didn't change the base case. We didn't change the base case. So that's what Excel will always recognize, that the base case remains the same because we never touch the base case. It still remains what it is. But here in the scenario values, we're going to alter here. We're going to change some things here to reflect the worst case scenario, right? Now, what we're going to do here now is to come back here and say, okay, now revenue growth. We had a forecast that in 2017, our revenue growth is going to be at a rate of 5%. Now, if we are pessimistic, then it's going to fall. It's not going to be 5%. It can be maybe 1% because we are pessimistic. Now, cost of goods sold is 37%. If we are pessimistic, it means it's going to be higher. We can say 50% because we are pessimistic. The next one is depreciation and amortization. Okay, we are at 40% base case. If we are pessimistic, it means it's going to be higher. Okay, if we are pessimistic, it's going to be higher. So we can say this to be 60% because we are pessimistic. Now the last one is the interest. Please, can we reduce the background noise? Please. Please, we should not distract the class. I probably should mute your. Let's try and reduce the background noise. All right. So the interest now, for the last one is the interest. We are at the base case of 3%. Now, if we are pessimistic, it means it's going to be higher. So if we are pessimistic, we will say that okay, due to the monetary policy, blah blah blah, we are actually pessimistic that interest rate is going to be higher than 3%. We are pessimistic. We have seen the economic variables, and we are pessimistic that interest is going to be higher than 3% for the forecast year 2017. So we can say interest is 7%. So pessimistic means it's going to be higher because it's an expense. Okay. So after defining all the pessimistic case, then you press OK. All right, so this is it. Now, what this actually means is that you have successfully defined what is optimistic and what is pessimistic, and you have also successfully informed Excel what the base case. You have successfully informed Excel what the base case scenario is. All right. Now, what you're going to do right now is you're going to go to summary. So what you're going to do right now is you're going to go to summary. So I'm going to click on summary. All right. So for summary, you will see summary, scenario summary, report type, scenario summary or scenario pivot. So just leave it as it is at scenario summary. So you leave it as it is at scenario summary and click on OK. Okay. Now, before clicking on OK, please take note of something. And this is where the error came from the last time. Okay. Now, if you check the last time, we were dealing with 2017 and the default setting was on 2018, and that was why the interpretation was wrong. So I'm going to take this out. Okay, I'm going to take this out. Always take this out and select what it should be. Ensure you select the right thing, which is what it should be. Now, because you are looking at 2017, you can see you're looking at 2017 here. So 2017 is what you're going to select and not 2018. So if you had the information here, in 2018, ensure you select 2017 because the assumptions you have picked is for 2017. If the assumption you pick is for 2018, then of course the scenario summary will be for 2018. Now, what are the scenario summary we want to look at? We want to look at EBITDA. We want to look at the impact of our optimism and pessimism on EBITDA, on EBIT, on EBT, and on net earnings. EBITDA, EBIT, EBT, and net earnings. So that's what we are picking for 2017. So if you go up to 2017, you're going to pick EBITDA 1, comma, you're going to pick EBIT, this, comma, you're going to pick EBT, and lastly, you're going to pick net earnings. You can see everything is for 2017. Everything is for 2017. So those are the steps that you follow. I will recap the step again. The step is, first of all, know what your assumptions is. The assumptions you are being pessimistic or optimistic about. Okay. Select your data. Go to your what is it called? What if analysis. Select scenario summary. Now under scenario summary, you pick those assumptions that will make up your changing cells. And once you are picking those assumptions, they automatically form your base case. After that, click on OK. Define what is optimistic case and what is pessimistic case, and click on OK. Then go ahead and select scenario summary. Go and pick the scenario output. And immediately you pick the scenario output, just click on OK. That's all. So those are the steps we have done here. We've carried out here. So the next thing is just to click on OK. And once you click on OK, Excel is going to run your scenario output. So it's going to take some time because it's an advanced analysis. So this is what you will have. So this is your scenario. You can see scenario summary. So this is what you have as your scenario summary, right? Now, what Excel is going to bring out is Excel is automatically going to create a new sheet for you and give you a scenario summary. Because we've had other scenario summaries before. That's why you are seeing scenario summary 4. If I unhide, you can see I've created some scenario summaries before. Okay, so that's why this is coming as 4. Otherwise, by default, it should come as scenario summary 1 or just scenario summary. All right. So this is what you will get. Now, what you will now do is you come back to your financial statement and scroll down to where you have a formatted table, because you must have formatted this already like this. Do you get? As that is going to give you something like this, but you cannot show this to the management because this is actually like workings. This is your working. Okay. So eventually you are going to hide this. You are going to hide this. All right. So what you're simply going to do is to come back to your financial statements. Okay. We'll go back to your financial statement and come and input your values here. So what you're just going to do is just say okay. Just say equals to. You're going to reference the current value. Take this down and take it like this. So that's all you have. So you come to 2017. Select this. Take it down and take it this way. Exactly. So this is what you have. So this is how you do your scenario analysis. So you can actually do this scenario analysis for any one of the forecast period. Okay, management want to see, okay, what if you want to apply to 2018? What if you want to apply to 2019? Okay, so all what you just have to do is very straightforward. It's just to still go back to, that's why it's a scenario manager, just to still go back to your data and click on your scenario manager. So from your scenario manager, you can change, you can come back to where you have, sorry, just come to optimistic and click on edit. So you can change this, what's it called, the changing cells, and go and pick the relevant year, maybe 2018, 2019, any of the years you want to analyze. So pick it, define what is optimistic, define what is pessimistic, run, what is it called, select the metrics you want to measure, then click on OK. So Excel will run it all over again for you. And at the end of the day, you will have your output. You have your output like this. So you can actually do scenario analysis for any of the. So what you just simply do is at the end of the day, you have another scenario summary here. So in the scenario summary, you still come back here and change whatever you have here, change it to the year you want to, particular year you want to see. So that's how you keep on, so that's how you keep on doing this scenario analysis for any of the forecast period. All right. So now, if you take a look at the typical financial model, this is what you have. Because if you actually look at what you have here, so let's see if this makes sense now. Our scenario summary. Now you can see that the current value we have is 5% here. We are optimistic. We are the current value is 5%, right? We are optimistic revenue will grow by 8%, and we are pessimistic it will drop by 1%. So if current value is 5%, our EBITDA is 64.7. We are optimistic that it will grow by 8%. Of course, if it grows, EBITDA is going to increase to 95.2. And if it drops by 1%, EBITDA will drop to 41.1. Now, the same applies to EBIT. You can see they are all moving in the same direction. Okay, optimistic, it went up, pessimistic, it went down. EBIT, base case, optimistic, it went up, pessimistic, it went down. Net earnings, base case, optimistic, it went up, pessimistic, it went down. So you can see this actually makes sense now. This actually makes sense. So that is what you will see. Now, as I said earlier, for you to have a complete financial model, this is what you actually have. You can see if I uncheck, if I click on all these minors that we have here, if I click on this of these minors that we have here, because I actually group all these. So a complete financial model is going to look like this. So look at what we have. You can see here we have the assumptions, we have the income statement, balance sheet, the cash flow statement, supporting schedule, financial indicators, sensitivity and scenario analysis, and lastly is going to be a DCF valuation. Okay, so this is what we want to look at today. So we're just briefly going to introduce ourselves to this before we now conclude on it. There will be a video that will be shared during the week that's going to be a concluding part. So now what I'm trying to say in essence is this: if you look at this, if in your company you have to set up a financial model, this is everything that your financial model should have. Your financial model will show your assumptions, will show the income statement, cash flow, supporting schedule, financial indicators or financial ratios, scenario and sensitivity analysis, and DCF evaluation. So this DCF evaluation that is here, right, is will show you the value of the company at any point in time. Now, what are we saying? For you to be able to know the value of a company at any point in time, as your assumptions are changing, your indicators are changing, scenarios, whatever things you have in your model are changing, the value of your company will also be changing. So this is how sorry, I need to admit someone. So this is how a comprehensive financial model is going to look like. Okay, this is how a comprehensive financial model is going to look like. So what we want to introduce ourselves today now to is business valuation. That is, how do you do valuation? How do you do valuation modeling? So once we are able to conclude on DCF valuation, because there are different ways there are different ways we can do valuation. Well, this course is actually about financial modeling and valuation. All right. So there are two different things. So the difference is when you are doing financial modeling is about financial statement forecasting. It's another word for saying financial statement forecasting. But when we are saying valuation is you're trying to determine the worth of a company. That means in case somebody wants to buy your company or you want to do a kind of merger and acquisition, how do you determine how much your company is worth? Are you getting me? How do you determine how much your company is worth? So that is what we mean by valuation. It's different from modeling entirely. So that's why it's most literature you will see financial modeling and valuation. You don't see they are actually two different things. But for you to do valuation, you must have done some forecast. Okay, so you must have done some forecasting, and that is why valuation and modeling are together. They always go they always go hand in hand. All right. So what I'm going to do right now is I don't know if anyone can hear me. Is someone still with me? Do we have any question as regards all this? Is there anything we don't understand? Can someone hear me?
Yes, I can hear you.
Yeah, please, is there anything we don't understand here? Before we move on to the next topic, because what we want to do is after this year evaluation now, we are going to move to an entirely um, new looking at a new company entirely, maybe financial institution. Then by I think today I should send you annual report of company. After this, okay, the sequence I want us to look at this is after this, we should look at how to we should look at all this using annual report of a company. So I'm going to send you a copy of annual report of a company, and we're going to work on all of this using the annual report of a company. So we actually see how this is done in practice. So it's going to be like for a historical period of let's say 5 years. Okay, so we're going to model a real company and see how we can apply all this stuff, sensitivity analysis, scenario analysis, and what have you. All right. So this is actually at the management case level. Management level. Okay. So do we have a question concerning all this? So I will assume we all understood what all this means. I'm going to assume everybody understands what assumption is, how to model three, how to do integrated financial statement model, how to prepare supporting schedule, financial indicators, how to carry out sensitivity and scenario analysis. I said this year evaluation that we haven't talked about. So I'm going to assume, since there are no questions, I'm going to assume we all know this. That's what it means. All right. So so what is going to happen now is, can someone hear me, please? So what is going to happen now is I sent a file out. Okay, I'm actually asking some of you to unmute so that you can ask your questions in case you have any. Okay, so what's going to happen here now? I sent the file out to you guys on the business valuation. So what we're going to do here is just to introduce us to. Okay, this is the salt. Let me see the salt. Okay, so what we're just going to do here is we're just going to introduce ourselves to business valuation. So we're not going to treat this now. We're going to treat this. We're going to treat this next week, or we're going to drop a video on this during the week. Then we'll look at it next week. So the idea is I want you to, for the other part we just concluded, I want you to practice that one on your own and be able to master it, because this is another new topic entirely. All right, so I'm going to drop the video for this week, but I'm going to explain, or probably just do the introductory part, but not the advanced part for now. All right, so now this is what we have for now. I will just quickly explain how we do valuation. Now, normally, I told you that there's a difference between valuation and modeling. So the two are interwoven because for you to be able to value a company, you must have done some level of forecast, right? And when you are doing your forecast, you do your forecast. Now, okay, let me start from here. A business as it is a going concern, right? Now, to value a company, you must do forecast and be able to see what is the free cash flow, uh, what is the free cash flow to the firm. Okay. Now, when you are doing your forecast, it's assumed that you cannot do your forecast to perpetuity. So at the end of, there should be a cutoff period where you'll be able to calculate what we call terminal value. Now there's a formula for that, which I'm going to introduce. I'm going to give you a note to this before we start this class. So there's a formula for that I'm going to give you. I'm going to give you the respective formula for you to calculate your terminal value, the growth rate, and what have you. So we are not going to discuss this for now. Otherwise, I think I'm going to be rushing if we just start going into the nitty-gritty of this for now, because valuation is very, very important. All right. So what I'm just going to do is during the week, we're going to drop a video on this. So you go through it, the video, then we are now going to repeat the class in case there are anything you don't understand. So that's what we're going to do. So I've actually sent you the note. I've sent you the note. So we're going to look at this during the week, right? We're going to look at this and we're going to introduce valuation. The concluding part of this question is we're going to see how we can introduce valuation into this model we've built from assumptions up to income statement, balance sheet, cash flow, supporting schedule, financial indicators, sensitivity, and scenario analysis. So once you have all this in a typical model, you have a complete model. Because at any point in time, you can tell what the value of the company is. You can see sensitivity, you can see indicators, and all the rest. So this is just the simplest case you can have. All right, so we're going to end the class here. So during the week, we're going to drop the video on that valuation. Then you can ask questions. You can raise questions on aspects you don't understand. Then we'll look at it all over again. Because we are. Now, do we have a question? Do you have any question?
Yeah, I have a question. Hello, I have a question. Hello? Yeah, can you hear me? Okay, my question is this. Yeah, can you hear me? Can everyone hear me?
I can hear you, but I'm trying to reach Mr. Wilson. I
Okay.
can hear you. I just have to
can we ask our question, please?
Okay. Yeah. So my question is this.
So can someone hear me?
Yeah, I can hear. Can you hear me? Okay, my question is this. I actually went through the file that was sent.
Okay, please.
Hello?
Yes, I can hear you.
Okay, you can hear me, right?
Sure.
Okay.
Loud and clear.
Okay. Yeah, I actually went through the file that was sent during the week regards the model, but I noticed something, that the files are actually coded. I mean, it is not. I could not depict the formulas behind the figures there. So
which file is that? Is it this one? This one I'm showing you right now.
Yes, that has up to. I think that it was the unsolved. It has solved or unsolved. I think it was the solved. Yeah, because I know there were 3 files that were sent for the past 2 weeks or so. Because I had to be watching the videos to really understand the nitty-gritty. But I noticed that the formulas were not there. So if the formulas were there, it would be easy for me to interpret so many things that were done, even as I was watching the videos. So is that a deliberate effort or?
No. The formulas are not hard coded. Maybe it was. I don't know. I will send the file again. I don't think the formulas were hard coded. Or maybe I don't know what could have happened. Maybe when I was maybe I sent the wrong file or something. But this is the file here. They are not hard coded. I will
was
send this
surprised
file
also.
again.
Okay.
I will send this
Okay.
one again.
Okay.
They are not hard
No
coded.
problem. Okay.
Is that,
No
is that
problem.
your only question?
Yeah, that's my only
Hello?
question because I wanted to work. I wanted to create my own. Everything I've done, I wanted to recreate it myself, but
You
I
create it
have to be
yourself.
watching the videos to. I have to be watching the video to realize. So if the formulas were there, it would have been much easier for me while I was doing that.
I understand. I will send it. So after this class, now I will send it again.
Okay. Okay. Thank you very
Yeah,
much.
I will send this particular one you are looking at. I will send everything again completely, up to sensitivity, scenario analysis, everything.
Okay. Thank you.
All right. Do we have any other question?
Yes, hello.
Yeah, I can hear you.
Okay, my own question is similar to one you just asked. I asked about mapping the other time. I didn't
Okay,
see any
mapping.
file that treated. I didn't see any file that treated mapping into two. The only one I can see was the first lecture we did. We only introduced it, but the way the steps of getting it done wasn't explained. And if there's anyone is not in the group, please kindly send it. So
Okay,
I've
no
been going
problem.
through the file one by one.
No,
Thank
no
you.
problem. But do you understand what mapping is? Do you understand what it is?
I think that's where it's a kind of grouping different items, like all these expenses, grouping it to like saying all the expenses are operating expenses. You want
Exactly.
so I
Exactly.
get it, but I didn't see the way it's done, and I
Okay.
think it's very important.
It's very, very important. It's very, very important.
I
In fact,
understand the
it's
concept, but I've not seen the way it's been mapped together.
mapped. Okay, okay, I understand. So what will happen is this. What will happen? You know, the last time when we treated mapping,
Okay.
actually, this is how it is done. When you export your trial balance from QuickBooks or any of the ERP you are using, you may have instances where you have different GL items that you need to group as one,
They are
so that you
similar.
can make your financial statements neat. And you understand what I'm trying to say.
I get
So
your
that
message.
is exactly. So that is what mapping is all about. I think we treated the question like that on mapping. So what I will just do is I will look for the
When we
balance.
that was the first file we did. You said this is an introduction that we are going to go detail into it. But I can't find any file that stated it except that.
Okay. So what I will do is I will look into my system and check out for that file. Probably
All
we
right.
may have to just treat just mapping alone,
Okay.
just how to map. I think most of us are having issue with that aspect, just mapping
Yes.
alone.
Yes.
I told you that we have different levels of mapping for you to prepare your financial statement. The
Yes.
ones that you
Yes.
can categorize all your line items either as assets, liabilities, equity, income, based on the elements of
Yes.
financial statement
You introduced
elements.
it the first time.
Yeah, I understand. I will look for that file. Probably we just have to do a recap on that. You understand? Yeah, hello, can someone hear me?
Yes. Yes. We are together.
Okay. So do we have any other question? Okay, so do we have a question on all this? That means we all understand everything here, right? Okay, no problem. So I'm going to assume we all understand everything that is here. So what is going to happen is that question on mapping, we'll revise that over the weekdays and see we can share the file again, just explain everything all through. But this is actually a financial modeling class, so it's just for us to, the basic thing is for us to know how to do forecast, valuation, that's everything about financial modeling. But it's equally important you know how to do mapping so that you can prepare financial reporting model. All right, so mapping is important. It's just mapping. When you hear the word mapping, it's just grouping. There's another for saying grouping. How to group your GL items so that you can easily summarize. It's for summary. You can easily summarize your trial balance and make it neat for you to prepare your financial statement. That's what mapping is all about. So we'll see can drop a video on that during the week. All right, so in case there are no questions, I think someone is raising their hand here. Yeah, Shaya, do you have a question? Hello? Can someone hear me? Okay, okay, no question. All right, so thank you very much, everyone. We may have to end this class here. So during the week, we will drop a video on the valuation, business valuation modeling, and we'll also see how we can start to work with annual reports, so we can actually see how this is done with real business case study. All right, thank you very much for your time. I appreciate it.